Welcome to the deep dive. Today, we're jumping straight into a market whisper you might have heard yourself.
Yeah, that one about September.
Exactly. Is September truly the toughest month for stocks? Or maybe you're just curious, why any month seems different in the markets.
It's a common question.
So our mission here is to cut through some of that noise. We're using your sources to really unpack the truth or, well, the patterns behind September's reputation. We'll look at the history, the reasons why, connected to uh, global stuff, and even what's coming up economically. Also, you feel genuinely well-informed.
That's the plan. In this deep dive, we'll cover that historical September effect on the S&P 500. We've got data from the last decade.
Okay.
Then we'll dig into the forces behind it, institutional, psychological, macro factors.
Right.
We'll also touch on how global events, maybe like those Japanese bond yields people talk about, or, European financial headlines, how they can magnify risks.
Interesting connection.
And finally, we'll zoom in on the key U.S. economic events scheduled for September 2025 and what they might mean for the market. It's a pretty full picture.
Okay, sounds good. Let's unpack this first bit then. Does September really deserve this reputation, this market bogeyman status? When people talk about the September effect, what are they actually seeing?
Well, it's definitely a pattern that's been around a long, long time. Historically, going way back to 1928, the S&P 500 has, on average, produced its weakest returns in September compared to any other month.
Wow, since 1928.
Yeah, and more often than not, it's been a down month over those really long time horizons. Now, its strength has, varied a bit.
Sure.
And maybe it's weakened slightly in recent decades, but look, it remains a widely cited signal thing that market watchers, well, they still pay attention to it.
That's quite a track record.
Yeah.
But okay, history is one thing. What about more recently? Can you give us a clearer picture, maybe from the last 10 years, say 2015 to 2024?
Absolutely. Let's look at that specific 10-year window. The average September return for the S&P 500 was actually negative 0.59%.
Okay, so negative on average.
And the median return, which sometimes gives a better picture, that was also negative, at minus 0.29%.
Right.
And maybe more telling, out of those 10 Septembers, 6 of them were down months.
6 out of 10.
But it's also really important to note the variability, the cross-year dispersion. That was around 3.20%, which just highlights that, the trend leans negative, but it's definitely not a guaranteed slam dunk that September will be bad. It jumps around.
Right. Not a certainty.
Yeah.
But the odds, you could say, tend to tilt that way. Could you give us an example from that recent data, like a really good September versus a really rough one?
Sure thing. In that sample, the biggest drop was September 2022. The S&P 500 fell a pretty significant 7.4% that month.
Ouch. Yeah, I remember that one.
Yeah. But on the flip side, the strongest up September we saw in that period was 2019. It had a positive return of 2.9%.
Okay, so quite a range.
Exactly. And just a quick note, these are price-only returns using monthly average levels, not total returns, but they still line up pretty well with those broader, long-run seasonality findings people talk about.
So, okay, why? Why does this pattern, even with all that variability, keep popping up? It can't just be random chance over all these decades, right?
You're right. It's definitely not just chance. There are several factors that seem to contribute. A big one is institutional portfolio adjustments.
Meaning the big players moving money around.
Precisely. For example, a lot of U.S. mutual funds have their fiscal year ending in October.
Ah.
So what do fund managers often do in September? They might sell assets, either to lock in gains they've made,
Right.
or maybe to reposition their portfolios before they have to do their year-end reporting, get the books looking right.
Makes sense.
And beyond that, you also see institutional investors more generally rebalancing after the summer break. They often trim back exposure to riskier assets, shift maybe towards more defensive stuff.
And all that selling creates pressure.
Exactly. It naturally creates selling pressure in the market.
And it's not just the big institutions, right? What about, regular investors coming back from vacation? Does that play a role after the summer lull? What happens with volume?
Yeah, that's another piece of the puzzle. Individual investor behavior definitely plays a part. Trading activity usually slows down during July and August. Summer months, people are away.
Quieter markets.
Right. But then September hits, everyone's back at their desks. Trading volume typically picks right back up. And with that increased volume, we often see an uptick in market volatility.
So more action, more potential for bigger swings.
Pretty much. It's like the market's getting back into full swing, and that just means more potential for those price movements up or down.
Okay, so we have the institutional rhythm, the post-summer return. What else is driving this? Are there bigger like macro things we need to consider?
Oh, absolutely. There are significant macro and political forces often at work in September. Think about it. September always coincides with the end of the U.S. fiscal year.
Right, September 30th.
Exactly. So that often brings political uncertainty. You get debates around budget approvals, sometimes even the threat of government shutdowns,
Which markets hate.
which markets definitely hate.
Right.
That kind of uncertainty can certainly rattle things.
And what about the Fed? You mentioned policy. How big a factor is the Federal Reserve's September meeting in all this?
The Fed is always a major player, but yeah, their timing matters too. Key policy meetings often happen in September, and sometimes these involve major decisions on interest rates or, liquidity measures. So just the fear of the Fed tightening monetary policy can quickly weigh on investor sentiment and push markets lower.
So policy uncertainty adds to the mix.
Definitely. And then beyond the concrete stuff, there's this powerful psychological effect we shouldn't ignore.
You mean just the idea of September being bad?
Precisely. The very reputation of September as a weak month can sort of become a self-fulfilling prophecy. Well, if traders and investors anticipate volatility or weakness, they might act more cautiously. Maybe they sell positions. Maybe they hold off on buying.
They get defensive.
Exactly. They adopt more defensive behavior. And that caution, that selling, in turn, adds to the downward pressure they were expecting in the first place.
Wow. It's almost ironic. The expectation helps create the reality. So is it possible that just knowing about the September effect actually makes it worse?
Yeah.
How much is real dynamics versus, like, herd behavior?
That's a really perceptive question. And yes, awareness absolutely plays a role. Think about it. If a whole bunch of market participants are braced for a tricky September, their collective actions, reducing risk, selling some holdings, maybe building up cash, those actions can definitely contribute to the downturn they were anticipating.
A feedback loop.
It really is. It's a powerful example of how market sentiment can directly feed into actual market movements, psychology amplifying the underlying dynamics, and then you layer on historical memory.
Like major crises.
Exactly. We've unfortunately seen major shocks hit in September. Think about the 9/11 attacks in 2001.
Right.
Or the Lehman Brothers collapse in 2008. Both happened in September. Events like that, they really cement a month's reputation, making it feel inherently like a dangerous month in the minds of many investors.
That makes sense. It really reinforces the fear. But okay, it's not just about the U.S., is it? You mentioned global turbulence earlier. How does instability elsewhere connect to this September weakness here?
You're absolutely right to connect those dots. Global financial uncertainty can definitely amplify the seasonal risks we already see in September in the U.S. markets.
So it layers on top.
It layers right on top. When you have international instability brewing, maybe worries about growth overseas or specific financial strains on top of these domestic factors like portfolio rebalancing and U.S. political stuff, well, the downside risks just become more pronounced.
Can you give us an example? How might that actually play out, like in terms of market moves?
Sure. Consider, for instance, some recent headlines maybe speculating about potential financial stress in, say, Europe.
Okay.
Now, whether those specific headlines turn out to be accurate or not isn't even the main point. Just the speculation itself can signal potential fragility in major financial systems.
And investors react to that signal.
Exactly. Investors often interpret these signs as broader systemic risk. And what happens then, you often see what's called a flight to safety.
Meaning money moves out of risky things.
Right. Capital rotates out of riskier assets like global equities and into perceived safer havens, things like U.S. Treasury bonds or sometimes just holding U.S. dollars.
And that selling pressure hits U.S. stocks too.
It does. That rotation adds downward pressure on American stock prices. Plus, global instability generally just tends to crank up overall market volatility. Markets become much more jumpy, more reactive to headlines.
Especially in September.
Especially when U.S. investors were already kind of on edge, adjusting portfolios, and maybe watching domestic political headlines closely too. It all adds up.
Okay, speaking of those global ripples, your sources also mentioned something that might seem, I don't know, a bit distant for someone managing their 401k. Japanese long-term government bond yields. JGBs.
Right, JGBs.
How on earth can something happening in the Japanese bond market impact, say, the S&P 500?
It's actually a fascinating example of how interconnected things are globally. Rising JGB yields can indeed have surprisingly broad and complex effects on global stock markets, including ours.
Okay, break that down for us.
Well, the main idea is that what might look like a niche bond market issue over in Japan can sometimes act as an early warning signal for wider global risk aversion.
How so? If yields go up there.
If yields go up significantly in Japan, it makes those Japanese government bonds, the JGBs, look more attractive compared to riskier assets like stocks, both domestic and international.
So Japanese investors might prefer to keep their money closer to home.
Precisely. Think about huge Japanese pension funds or insurance companies. If the 10-year JGB yield climbs from, say, 1% to 2%, that's a big jump, relatively. They might start shifting money away from global stocks, maybe selling some of their holdings in U.S. tech giants, your Apples, your Microsofts, and redirecting that capital into those newly appealing domestic bonds.
Okay, less foreign money buying U.S. stocks creates selling pressure.
Exactly. It reduces that foreign investment flow and can definitely create selling pressure, maybe weighing on indices like the NASDAQ, where those big tech names live.
And that would presumably affect the currency, too, the yen.
It absolutely would. Typically, rising bond yields in a country tend to strengthen its currency because foreign investors need to buy that currency to purchase the bonds.
So a stronger yen.
Right. But a stronger yen can be a double-edged sword, especially for Japan's export-heavy economy.
How's that?
Well, if the yen gets stronger, it makes Japanese products more expensive for foreign buyers. Think about a company like Toyota. If they earn a lot of revenue in dollars, but the yen strengthens, those dollars translate back into fewer yen on their balance sheet.
Hurting their profits.
Exactly. Which can then drag down the performance of Japanese stocks, like the Nikkei 225 index.
Got it. And this ripple effect, it doesn't just stop with Japan and its currency, does it? Does it push further out?
It really does. It extends further. If Japanese yields climb significantly, it can actually put upward pressure on U.S. Treasury yields as well.
How does that link work?
It's about global capital flows and relative value. If JGBs become more attractive, global investors might demand a higher return to hold U.S. debt compared to Japanese debt, especially since Japan holds so much U.S. debt itself. So they adjust portfolios, potentially selling some treasuries, which pushes U.S. yields up.
And we know higher U.S. yields aren't always great for stocks.
Especially not for growth stocks.
Right.
Those companies, the Teslas, the Nvidias, their valuations are often heavily based on expected future cash flows.
Right.
When you discount those future cash flows back to the present using higher interest rate or yield, their present value decreases. It makes them look less attractive from a valuation standpoint.
So it's like this chain reaction. Japan yields rise, Japanese investors potentially sell global stocks, yen strengthens, maybe hurting Japanese stocks. U.S. Treasury yields might rise. U.S. growth stocks feel the pressure.
Wow. That's a good summary of the potential chain. And there's one more risk factor tied to this.
What's that?
The risk of policy shifts from the Bank of Japan itself, the BOJ.
The central bank stepping in or stepping back.
Exactly. Markets watch the BOJ very closely. If JGB yields start rising sharply, markets might interpret that as a signal that the BOJ is finally moving away from its decades-long ultra-loose monetary policy.
Which has been a global anchor, in a way.
It really has. So any potential shift away from that can really unsettle global markets, particularly if the BOJ maybe lets yields rise above its target range under its yield curve control policy.
And what happens then?
Well, that could trigger hedge funds and other players to unwind what are known as carry trades.
Right, borrowing cheap yen to invest elsewhere.
Precisely. They borrow yen at super low rates and invest in higher yielding assets around the world. If the yen starts strengthening or Japanese rates rise, those trades become less profitable or even loss-making.
So they have to unwind them quickly.
They often do. They have to sell the assets they bought. Could be anything from emerging market stocks to U.S. bonds in order to buy back the yen to repay their loans. And that rapid selling can cause significant volatility across global markets.
Okay, that clarifies the JGB connection quite a bit. So bringing it back home, what does all this mean for you as you look specifically at September 2025? Your sources laid out a calendar of key U.S. economic events. Let's highlight the really important ones people should watch.
Yeah, it's definitely shaping up to be a busy calendar. Right at the start of the month, around September 2nd, keep an eye out for the ISM manufacturing PMI. That gives a sense of factory activity.
Yeah.
But the really big one early on is likely September 5th. That's when we get the U.S. Employment Situation Report.
The jobs report.
The jobs report. Non-farm payrolls, the unemployment rate, hourly earnings, all the key stuff.
And the impact there.
Well, generally, strong job growth might signal to the Fed that the economy is still running hot, making them less likely to cut interest rates. Weak data, on the other hand, could support the case for easing policy. It's always a huge market mover.
Definitely one to circle. What comes next? Mid-month.
Moving into the middle of September, around the 11th, we'll get the CPI, the Consumer Price Index.
Inflation.
The big inflation number everyone watches. If it comes in hot, suggesting inflation is still sticky, that could delay any hopes for Fed easing. But a cool CPI reading, that could see markets rally on rate cut expectations.
Always a nail-biter. What else mid-month?
Then around the 16th, look for retail sales figures. Consumer spending is the main engine of the U.S. economy, so strong sales suggest growth resilience.
And the Fed itself is back in the spotlight then too, right?
Absolutely. September 17th looks like the biggest single event of the month, the FOMC rate decision.
The Fed's announcement.
Exactly. Whatever the Federal Reserve says about interest rates and their outlook, their guidance, that directly impacts everything. Stocks, bonds, currencies. It's pivotal.
Okay. Anything else around that time?
On the same day, actually, we usually see housing starts and building permits. These are important indicators for the health of the housing market, which is very sensitive to interest rates.
Right. And as we get towards the end of September, what should we be tracking then?
In late September, maybe around the 25th, we'll get the third and final estimate for Q2 GDP growth.
So confirming how the economy was doing earlier in the year.
Right. It confirms the trajectory and affects forecasts going forward. Then around the 26th, look for personal income and spending data again, key for understanding household consumption trends.
And housing keeps popping up.
Yeah, throughout the month, you'll see various housing data points, existing home sales, new home sales. Keep an eye on those, as weakness can suggest that monetary tightening is really biting.
And consumer confidence.
Good point. Various consumer confidence reports also come out during the month. They're important because they shape expectations for future spending, which is crucial for overall economic growth. If people feel nervous, they tend to spend less.
It's really striking how interconnected this all is. Like you said, these reports don't exist in a vacuum. A strong jobs report might make the Fed hesitate, which then affects bond yields. And suddenly those Japanese GGB yields we talked about might feel, I don't know, a lot more relevant to your portfolio here.
That's exactly it. It's a complex web. These events interact, sometimes amplifying each other, sometimes maybe dampening effects, especially during a month like September that already has these known seasonal tendencies.
So being aware of the calendar is key.
Being aware of the calendar and the potential undercurrents allows you to approach the market with a more, let's say, informed perspective rather than just reacting emotionally to every headline.
Okay, well, we've definitely covered a lot of ground in this deep dive. We went from those long-term historical patterns all the way to global ripple effects like GGBs and right down to the packed economic calendar for September 2025.
Indeed. And the core message really is that September's reputation as a potentially weaker month for stocks isn't just superstition. It seems rooted in a blend of things. Statistical history, yes, but also real institutional behavior, powerful psychological factors, and those broader macro and political dynamics we discussed.
And global events can make it worse.
Absolutely. That underlying tendency can definitely be amplified by global turbulence. And of course, any specific economic data release coming out during the month has the potential to create significant market movements on its own.
But it's not guaranteed.
No, absolutely not. It's crucial to remember it's not a guaranteed rule that September will be down. It's a pattern, a tendency, but one worth understanding.
So wrapping this up, what does this all mean for you, the listener, as you try to navigate this financial landscape?
I think it means that staying informed about all these different forces, domestic, international, psychological, calendar-driven, is maybe more crucial than ever.
It's about seeing that bigger picture, the context.
Exactly. Seeing the context, understanding the potential pressures.
All right. And maybe to leave you with a final thought to chew on. If we accept that the September effect is, at least partly, a self-fulfilling prophecy driven by investor psychology, what power does that give to informed, independent thinkers like you? Can you subtly shift that narrative, or maybe at the very least, avoid getting swept up in the herd mentality? Something to consider.
A very interesting question.
Thank you for joining us on this deep dive.